Imagine taking just one single dollar and investing it back in 1965.
Today, that single dollar is worth more than $55,000. Same stock market everyone else had access to, same automated compounding rules, but a vastly different understanding of wealth. It's the difference between being rich, which is usually just about outward consumption, and being truly wealthy, where your passive income finally exceeds your living expenses.
So why did almost no one else get this wealthy from it? By the end of this video of these concepts, you'll understand the one law that decides whether your money just moves or actually multiplies. Right now, you're probably using about 1% of what you already know about money. You know saving is good and working hard matters, but knowing the rules and understanding the laws behind them are two completely different things. And we'll also go over the exact 5-question filter that billion-dollar investors run every single deal through before they say yes.
Today, we'll break down the laws of wealth, time versus speed, the power of leverage, cash flow versus equity, surviving downside, and that 5-question billion-dollar filter. Part 1. Time versus speed. Moving versus multiplying. Confusing time and speed is the single most expensive mistake in personal finance, and it's probably costing you more than you think. Here's why. Picture two people, same starting capital, same 5 years. Person 1 moves fast. Every few months they flip a deal. By year 5, they've flipped over 30 properties. On paper, they look like the aggressive, hungry investor. Person 2 does almost nothing. They buy one property, wait 2 years, refinance it to buy a second, wait again. By year 5, they own 4 appreciating cash-flowing properties. Person 1 generated more transactions. Person 2 built roughly 5 times the net worth by letting their capital work harder than they did. Speed is the gap between seeing an opportunity and acting on it. Time is what happens after you've already made a good decision. That's exactly why most people quit right before compounding kicks in.
And most of you aren't flipping real estate, but you're running this exact same trade-off in your career right now. Job hop every 18 months for a 10% raise, and your income looks great, but you're resetting your equity to 0 every single time. You never trade your skills for equity. Meanwhile, a smarter approach is the 9-month transition strategy, keeping that steady paycheck while aggressively reclaiming your personal time to build a self-sustaining side venture. Instead of chasing fast raises, which is speed, you protect the gap between your earnings and spending to build real ownership. Almost nobody tells you that chasing the fastest paycheck is often the slowest path to actual wealth. A steady paycheck without equity is just a precarious single point of failure.
So if time beats speed, here's the proof at a scale that's almost hard to believe. Look at this table. Berkshire Hathaway has compounded at just under 20% a year since 1965. The S&P 500, which you can easily access through automated index funds that compound reliably over decades, sat at about 10% over that same stretch. That doesn't sound like a huge gap, right? But compounded across 60 years, Berkshire's total return crossed an absolutely mind-boggling 5 million%. The S&P's total return was about 39,000%. One extra decade of patience was worth more than several decades of frantic trading.
Part 2. The power of leverage, the great multiplier. But here's what almost nobody tells you. Time alone isn't enough. Time with the right tool just sits there quietly, going nowhere fast. And this next law is the one that actually multiplies everything, for better or worse. That law is leverage. As we see on this slide, leverage is the tool that multiplies whatever you feed it, good decisions or bad ones. Let's look at how this brilliantly illustrates the concept. Say you buy a $400,000 house, all cash, and in 3 years it rises 10%. Awesome, you made $40,000, a 10% return on your own money. Now say you only put $80,000 down and borrowed the rest. Same house, same 10% rise, same $40,000 gain. Except now, because you leverage the bank's money, that is a massive 50% return on the capital you actually risked. That's not a trick. That's leverage doing exactly what it's built to do.
It's part of why billionaires like Elon Musk borrow against stock instead of selling it, like lining up a $12.5 billion loan backed by Tesla shares for his Twitter purchase. But it's not just stocks. Think about Michael Saylor, who famously utilized artificial intelligence and Bitcoin to engineer multi-billion-dollar financial instruments by leveraging assets to outpace monetary inflation. When inflation acts as a silent tax that halves your purchasing power every decade, leverage, technology, and AI become crucial tools to solve complex financial challenges, rather than just using tech for trivial tasks.
Part 3. Cash flow versus equity, the real prize.
Leverage is just a multiplier. What you actually own underneath it decides whether that multiplier builds your fortune or buries you. Which brings us to a difference almost nobody explains correctly.
Cash flow keeps you alive, but equity makes you free. Take McDonald's. Everyone assumes McDonald's makes its money selling burgers. It doesn't. McDonald's real estate holdings are worth more than $42 billion, and rent from its own franchisees makes up roughly 33% of the company's entire revenue. The burgers get people through the door, but the real estate is the equity that built one of the most valuable brands on earth. The cash flow was never the wealth. It was just the fuel that bought the equity.
Part 4. Surviving the downside. Protect your empire. Now, once you understand equity is the real prize, you have to ask, how much of your empire are you actually willing to risk to get it? The moment people learn that leverage and equity build wealth fast, some go all in. And when that single bet fails, there's no time left to recover. The wealthiest investors run every decision through one filter. Never risk the entire empire for one pot of gold. This is what's known as the Dondo philosophy. Looking for business ventures with high potential rewards but heavily capped downsides. That's asymmetry. Capping the downside while leaving the upside uncapped. It's how you win big without the risk of going back to zero.
Mark Cuban bought the Dallas Mavericks in 2000 for $285 million. He didn't flip it. As this timeline shows, he held it for 23 years before selling his majority stake at a $3.5 billion valuation. He didn't need speed. He needed to survive 2 decades without needing that money back. Speed decides how fast you start. Time decides how big it becomes. Leverage decides how far it stretches. Equity decides whether it lasts. And sizing your risk decides whether you're still standing to enjoy any of it. Miss one of these, and the other 4 don't save you.
Now, I know exactly what you're thinking. What if you're starting from zero capital? Here's the truth. You don't need capital first. You need patience first. Because patience turns small, boring cash flow into real equity. Achieving this requires breaking past internal psychological barriers regarding money. Every single example in this video started as one small position, held over time, then leveraged carefully once it proved itself. The order was never get wealthy, then be patient. It was always be patient, then get wealthy.
Part 5. The 5-question filter before you invest.
So here's the gift I promised you. The exact 5-question filter that billion-dollar funds run every decision through before they commit a single dollar. 1. Can this compound? Is it actually a long-term position or just a quick flip? 2. Who is really in control here? You or someone else? 3. What happens if this fails completely? Do you get any of your money back? 4. Is the upside meaningfully bigger than the downside, or are you risking a lot to gain a little? And 5. Do you understand this well enough to explain exactly what could go wrong?
Answer those 5 questions honestly before your next decision, and you stop chasing money and start building wealth. That is the actual shift, from reacting fast to compounding on purpose. So look at your current job, your current investments, and your daily habits, and ask yourself this final question. Are you just moving your money around, or are you actually multiplying it?